When we look at a market in motion, we're really looking at a crowd revealing its intentions in slow motion. And today, I want to walk with you through that very process as it unfolds around mRNA, because understanding whether a stock is slipping into a true Wyckoff-style accumulation phase can tell you more about the future than any headline ever will. Before we dive in, let me briefly tie this into something familiar. This whole reading of the tape connects naturally to what we explored in the previous video on Learn the Silent Trend Signal. That rarely fails, because both ideas revolve around spotting behavior before the crowd notices. Now, when you examine mRNA's recent structure, you may notice what appears to be a stock that has undergone a long markdown, leaving traders tired and uncertain. But let me ask you, haven't you seen this movie before? Haven't you seen a stock get pushed down, volume dry up, fear take over, and then something subtle shifts? This is the moment when the composite operator, the seasoned, deep-pocketed interests, begins taking a closer look. And if you've spent enough time studying market behavior the way I have, you know that these quieter phases aren't accidental. They're preparatory. Think of how a master operator works. They do not chase, they accumulate. Gradually, cautiously, often invisibly. And as I look at the action in mRNA, I see the early outlines of that familiar behavior. Wider selling waves losing force, smaller reactions within the range, and traders in the public group misreading the pause as a continuation of weakness. Have you ever wondered why the market behaves this way, almost as if it's testing your patience? Well, this is part of the process. The market must shake out the weak before it rewards the patient. As the stock glides into what appears to be a potential preliminary support zone, the selling seems to meet just a bit more interest than before. You might notice that the decline doesn't stretch as far on the chart, or that the volume spikes are more muted. These subtle signs, though humble, tell you a story. They whisper that someone with intention is becoming active. After all, if distribution is fading and supply is absorbed, what tends to come next? But of course, nothing here is guaranteed, and you and I know better than to treat any formation as a promise. Still, watching the relationship of price and volume unfold is like watching the first brushstrokes of a painting. And this brings me to something I want you to consider. Accumulation is not an event, it is a phase. Too many traders look for a single bar, a single news announcement, a single moment of clarity. But real accumulation is slow, non-dramatic, and deliberate. Now ask yourself, are you patient enough to recognize it when it's happening? Are you willing to study the range while others complain that nothing is happening? Because this is where real skill is built. And somewhere in the middle of this range, you may sense that familiar, silent signal again, the same kind we discussed in that earlier video about the silent trend cue that rarely fails. Here, it shows up not as a breakout, but as a subtle shift, shortening thrusts, decreasing downward momentum, and occasional pockets of strength that the uninformed dismiss as noise. But you and I were students of behavior. We know that these little clues often mark the turning of the tide long before the public recognizes it. When you think about market psychology, you realize how much of your success depends on reading what others ignore. So let me ask you, how comfortable are you taking the opposite side of mass emotion? How comfortable are you treating a long, frustrating base as a sign of potential opportunity instead of stagnation? This mindset separates the trader who survives from the one who simply drifts along with the crowd. If the crowd sees boredom, the professional sees preparation. mRNA's current structure invites this kind of thinking. When you inspect its swing highs and lows within the range, notice how the reactions behave. If the selling waves lack commitment, if demand steps in just enough to steady the decline, yet not enough to spark a breakout, that often tells you the composite operator is still working quietly. They don't want excitement yet. They want calm. They want uncertainty. They want the kind of environment in which they can accumulate without competition. Doesn't it make sense that the market would mask opportunity behind monotony? And it's worth reflecting for a moment on your own internal process. Do you have the discipline to wait for confirmation without rushing? Because accumulation phases reward the trader who can observe without forcing an outcome. I've met many who feel the urge to predict every turn, but prediction is not our job. Our job is interpretation, reading the actions of supply and demand, and responding only when the market reveals enough to justify involvement. If MRNA is truly entering an accumulation phase, the market will show its hand piece by piece, not all at once. Another point to watch is the character of the secondary tests. Are they shallower? Do they attract less volume? Do they reveal signs of absorption? These are the kinds of questions that guide you through Wyckoff's method without needing any elaborate tools. Simplicity is your ally. Complexity is what confuses most traders into bad habits and reckless entries. But clarity comes from seeing the movement of effort versus result. And while we talk about wealth building, remember your edge is not in predicting the future, but in recognizing what others overlook. Wealth, in trading, accumulates the same way operators accumulate stock, quietly, gradually, with consistency, not haste. The steady trader who respects phases tends to remain solvent long enough to benefit from the market's major turns. That is why an apparent base like the one forming in MRNA should draw your attention. Not because it promises riches, but because it represents potential. Potential that can only be unlocked through methodical and disciplined study. As the stock continues to coil inside its structure, the real question becomes, what does the composite operator want you to believe at this stage? They want you bored. They want you doubtful. They want you to forget the stock exists, so that when the moment of up eventually arrives, you are either unprepared or late. But you, as a student of Wyckoff principles, know better. You understand that nothing meaningful happens without a cause, and a base of this scale, if it indeed continues to mature, forms the cause for a future effect. So as you observe the range developing, keep asking yourself who is in control. When you look at a stock that has been beaten down for months, sometimes even years, the simplest clue that something meaningful may be shifting is the way supply begins to behave. For MRNA, the idea that the stock is showing early signs of supply exhaustion isn't just a casual observation. It's a reading of behavior, a glance at how the market's rhythm changes when the dominant pressure begins to fade. And remember, we're not talking about a sudden miracle candle or a dramatic reversal. Supply exhaustion in the Wyckoff sense is often subtle, quiet, almost shy in its appearance. It hides in the corners of the chart where most traders aren't even looking. That's why this concept is so powerful when you understand it deeply. Think about how selling looks during a true markdown phase. The waves of decline tend to be decisive, wide-ranged, supported by heavy volume, and fueled by fear or disappointment. Every rally attempt fades quickly because supply is overwhelming. Sellers dominate every uptick, as if the stock can't breathe for more than a few moments. When a stock like MRNA is in that kind of environment, the chart speaks very loudly. You see conviction in the selling. But over time, if operators have met their objectives and the weaker hands have already been forced out, the market begins to behave differently. This is where supply starts losing its grip. One of the earliest indications of supply exhaustion is that selling waves begin to shorten. Picture a decline that used to drop 10 or 12%, now barely making it to 5 or 6. Price might still fall, yes, but the effort behind that fall shows less and less result. That effort-result comparison is one of the most beautiful parts of Wyckoff's methodology. It's simple, but it reveals the underlying motive forces in the market. If large amounts of supply were still present, a modest push would still create a deep markdown. But when supply begins drying up, even strong pushes deliver weaker outcomes. The market feels heavy, but only in appearance. Underneath, the pressure is quietly fading. Then you might look at volume. True supply exhaustion often shows up in the bars where the stock dips but the volume remains muted. It's almost as though the market is asking, who is left to sell? A big gap down with enormous volume typically signals capitulation, but a gentle slide with tiny volume often signals disinterest rather than fear. And disinterest in a downtrend is a powerful clue. It tells you that the urgency to exit is largely gone. Think about that for a moment. How many traders even consider that low volume on a decline can be bullish? Most simply see red candles and assume weakness. But if you've studied enough charts, you know how deceptive surface level weakness can be when supply is actually thinning. Another subtle sign is the behavior of the reactions after news events or sudden market shocks. During a heavy supply environment, any negative news sends the stock plunging rapidly. But when supply is exhausted, bad news still pushes the stock down, yet the decline halts earlier than expected. You might catch the stock stabilizing quickly, finding support at a level that previously wouldn't have held. Why? Because the people who wanted out are already gone. There are no mobs of sellers left to push it further. Even unfavorable conditions lose their ability to create meaningful damage. This is how professionals read the tone of the market long before a breakout appears. They watch how the stock absorbs negativity. You can also observe the nature of intraday recoveries. A stock under heavy supply usually closes near the lows of the day because sellers dominate the close. But when supply weakens, you often see price dipping early and recovering later, or drifting lower but getting quietly bought. The candles become less aggressive. The structure becomes more balanced. It's like watching the tide change, not with a splash but with a shift in direction that only the attentive notice. This is why Wyckoff always emphasized the study of the tape, the ongoing reading of intention. You don't need confirmation from the crowd. You just need the skill to interpret what the chart is already whispering, and think for a moment about who is actually absorbing supply when this exhaustion occurs. It's rarely impatient retail traders. Absorption typically hints that larger players, the composite operator in Wyckoff's language, are stepping in quietly. They're not trying to turn the stock around overnight. They're simply taking the other side of the trades that remain, and because the supply is dwindling, their presence becomes more noticeable in the structure of price movement itself. Even if they aren't buying aggressively yet, their passive absorption already shifts the balance. They're letting the market do most of the work while preparing for something larger ahead. If you examine the wider context, you might see that MRNA's decline has stretched long enough that sellers are fatigued. That fatigue shows up in every small detail: the slower pace of markdown, the inability to break prior lows with conviction, the decrease in panic-driven candles, the lack of urgency among investors who once rushed for the exits. These small clues accumulate, painting a picture of a market where supply is no longer a dominating force but a fading one. And when supply fades, it creates the conditions under which accumulation can begin, not as a dramatic event, but as a quiet shift in power from weak holders to strong hands. When you talk about a potential Wyckoff-style preliminary support zone forming in MRNA, you're talking about a moment in the market where something important starts to change beneath the surface. A preliminary support zone, often called PS in Wyckoff language, is that early hint, that first structural sign that the intense selling pressure of a markdown may finally be meeting meaningful buying interest. Not enough to reverse the trend, not enough to ignite a rally, but enough to slow the descent and signal that stronger hands are beginning to step in. And remember, this is never a loud moment. It's quiet, subtle, almost easy to ignore if you're not trained to look for it. Think of what the chart typically looks like just before preliminary support emerges. The stock has likely been in a persistent downtrend, printing new lows, breaking through supports that once looked strong, and doing so with broad, heavy waves. Traders watching that kind of movement get used to the idea that every rally is just a setup for another decline. Momentum traders sell into strength, long-term holders capitulate, and fear becomes the dominant emotion. In that environment, the market is almost one-sided. Everyone accepts the downtrend as obvious. But markets rarely move in straight lines forever, and when a trend becomes too obvious, that's often when the composite operator starts paying the most attention. Preliminary support is where that shift begins. The stock reaches a level where the selling pressure that once dominated starts to clash with an emerging source of demand. You might not see a dramatic bounce. In fact, you usually don't. Instead, you see the decline slow down. That's your first clue. A downtrend that once produced aggressive, accelerating drops now hesitates. The candles become smaller. the move loses its urgency. And if you look closely at the volume, you may notice that while the stock still falls, the selling is being met with enough buying to keep the decline from unraveling further. Sometimes you'll see volume increase slightly as the stock hits a new low, not because panic is returning, but because buyers with deeper pockets are beginning to absorb what's left of the supply. Have you ever watched a stock fall and thought, it should have dropped farther than that? That's often the feeling traders get during preliminary support. A negative news event hits, the stock undercuts a previous low, but then it stops falling sooner than expected. Or maybe it briefly dips below support, but snaps back with surprising ease. That's not retail optimism doing the work. That's the early footprint of accumulation. Small, restrained, invisible to the untrained, but perfectly recognizable to those who understand Wyckoff's logic. One of the reasons preliminary support is so important is because it defines the lower boundary of the developing trading range. Without PS, you don't have the structure for accumulation to build. It's the moment where the market sends a quiet message. There may be enough demand here to slow the fall. And this slowing is exactly what institutional accumulation needs. Strong hands do not accumulate in a free fall. They wait until they can absorb shares without competing with panic. A preliminary support zone is the first sign that panic is being absorbed, not amplified. Think about the behavior of price during this moment. You might see wide bars still appear, but they begin closing higher in their ranges rather than at the lows. You might see intraday volatility stay elevated, but the net progress downward slows. You might see selling spikes that used to drive the stock sharply lower now result in only modest declines. This is the friction between supply and demand becoming visible. Wyckoff always taught that markets reveal themselves in the struggle between these forces. Preliminary support is the first insight into that struggle transitioning from imbalance to balance. This is also a moment of psychological tension for most traders. The public often sees a stock hitting new lows and assumes more destruction is ahead. And ironically, that's exactly when stronger hands are most interested. The public sees fear, professionals see opportunity forming, and the beauty of preliminary support is that it is not yet exciting enough to attract attention. It's quiet, it's boring, it's just a slowdown. Most traders overlook it because they want clear signals, big moves, confirmation. But by the time confirmation arrives, the smart money has already finished most of its absorption. And when you study the chart deeply, you'll notice that preliminary support rarely forms as a single bar or a single day. It's a zone. It's an area where the market meets repeated selling attempts with increasingly effective absorption. A washout might occur, but instead of cascading into deeper lows, it stabilizes. The market pauses. It hesitates. And in Wyckoff's world, hesitation after a long decline is never random. It is the market's language telling you the immediate trend is losing breath. This zone often precedes the selling climax, which comes later and with more emotional force. But PS is the first alert, the first whisper. It's the moment when you need to start paying attention. Not acting aggressively, not predicting a bottom, but observing the shift in character. Because if you don't recognize preliminary support, you'll miss the entire structure that follows the selling climax, the automatic rally, the secondary tests, and eventually the full accumulation range. When you say that volume behavior in MRNA is beginning to suggest quiet accumulation rather than aggressive selling, you're really talking about one of the most revealing aspects of Wyckoff analysis. Volume is the market's voice. It tells you where the effort is, where the intention hides, where the unseen hands are doing their work. And when a stock transitions from distribution through markdown and into the earliest parts of a potential accumulation zone, that voice changes tone. It doesn't shout, it softens. It becomes less emotional, less panicked, less explosive. That quietness is exactly what makes it so important. Think back to the heart of a downtrend. What does volume usually look like there? You often see heavy, persistent selling pressure. The bars are loud. The reactions are violent. Fear ignites urgency, and urgency shows up as heavy volume spikes pushing price lower. Market participants are trying to exit at any cost, and the chart reflects that desperation. But as a decline matures, that kind of aggressive behavior doesn't last forever. Sellers get exhausted. Weak holders get shaken out. The people who were most eager to leave have already left. What you're left with is a shift in the character of volume. Quiet accumulation begins long before most traders recognize it. It begins when the composite operator starts absorbing shares without drawing attention. This type of buying doesn't come with huge, dramatic surges in volume. It comes with controlled, deliberate absorption. You might notice that while the stock continues to drift downward or sideways, the volume accompanying those moves becomes subdued. The bars shrink. Selling pressure looks less committed. Even on days when the price dips, the volume doesn't confirm fear. It reflects a kind of mechanical trading rather than emotional trading. That subtle quietness is important. It tells you that the market is not reacting to fear anymore. Instead, the remaining sellers are fewer in number, and the buyers stepping in are not chasing. They're patiently taking shares as they come. This is how the foundation of accumulation typically forms. Not with fanfare, not with obvious bullishness, but with a gradual decline in emotional volume followed by selective, intention-driven activity. Look at the way down days behave when quiet accumulation is starting to appear. You often see declines on increasingly lighter volume. A down bar that previously came with a dramatic spike may now appear with volume half the size, or less. If the composite operator were aggressively selling, you'd expect volume to expand, not contract. But when you see price making new lows or retesting old lows while volume contracts, asking yourself who is left to sell becomes meaningful. Weak selling pressure is a clue. It tells you the supply is drifting lower and that selling lacks conviction. The inverse appears on certain up days. You might catch a day where the price rises slightly, but the volume ticks higher than usual. Not dramatically higher, just noticeably elevated. These small pockets of volume on up days often hint that professional interest is there, but not yet ready to be obvious. Accumulation rarely starts with high energy buying. That would alert the crowd. And professional traders, the composite operator, avoid waking the crowd until they're finished building positions. So instead of bold buying days, you get quiet nudges, selective activity, little bursts of interest that seem out of place unless you're paying attention. Watch the volume on reactions to news. When fear is still dominating a stock, bad news sparks a surge in volume as traders rush to the exits. But when accumulation begins, the same bad news might produce less volume than expected. The market still reacts, yes, but it reacts softly. That softness is the composite operator's hallmark. They're absorbing supply at their preferred price levels, preventing the stock from collapsing, but not forcing it higher either. This is how they maintain a calm environment that allows them to accumulate without competition. You might also notice that after a long period of selling pressure, the stock begins to stabilize even though it hasn't technically formed a breakout or even a clearly defined bottom. This stability often comes with quieter volume. Traders who rely only on price often misinterpret this stage as nothing happening. But if you study Wyckoff, you know that nothing happening is sometimes the most informative condition of all. A quiet market after a long decline is rarely a coincidence. It's usually preparation. And remember that volume is not just about how much trading occurs, it's about what kind of trading is occurring. Chaotic volume shows panic. Expanding volume shows aggression. But declining volume during a decline shows apathy among sellers. And apathy among sellers is a textbook sign of a market preparing for a shift. When volume dries up on sell-offs, it's often because the composite operator has already absorbed much of the floating supply. They don't need a lot of volume to maintain control. They need the absence of competition. Quiet accumulation also shows up in the relationship between volume and volatility. If volatility contracts while volume remains soft, it means the market is becoming balanced. The imbalance that drove the previous downtrend is losing force. Price stops accelerating downward. Reactions become smaller. This is not yet strength, but it's a precondition for strength. Before price can rise meaningfully, supply must be absorbed, and absorption is almost always accompanied by quiet volume signatures. when you observe that downward thrusts in MRA are beginning to shorten. What you're really noticing is one of the most revealing signs of a potential shift in control between supply and demand. In Wyckoff's language, the shortening of the downward swing, the decreasing ability of price to travel lower despite continued selling attempts, often signals that supply is losing its dominance. And while it might look subtle on the surface, it carries enormous meaning beneath the chart's structure. The market is telling you that the sellers who once commanded every move no longer have the same impact they once did. Think about what a downward thrust looks like in the early or middle stages of a markdown. The swings are wide, the declines are persistent, the reactions to the downside appear almost effortless. Price gets pushed lower with strong momentum, and even small bouts of selling can take the stock down several percentage points. This is what a market under the control of supply looks like. It's forceful, it's one-sided, it's almost merciless. Traders feel the pressure, and that pressure shows up in both price and volume. But as the decline matures, the story begins to change. The market rarely tells you outright that the tide is shifting. Instead, it whispers. One of the earliest whispers is that the downward swings don't travel as far as they used to. A thrust that previously carved out a sizable drop now results in a smaller move. A wave that should have broken through support struggles to do so. The decline becomes sluggish, heavier in appearance but lighter in actual progress. This slowing down of the downward motion is not random. It's structural. The market is revealing that the amount of supply available at lower levels is shrinking. When you see price making attempts to break to new lows but failing to extend, it tells you that demand is starting to show up more consistently. Not enough to push the stock upward in a clear rally, but enough to mute the declines. And in Wyckoff's world, muted declines are far more telling than flashy rallies because they show who is quietly stepping in. You don't need a dramatic reversal to see strength forming. You need shortening thrusts. You need waning selling pressure. You need evidence that effort is producing less and less result. You might also see that each new low is only marginal, barely dipping below the previous one or simply matching it. This kind of behavior often confuses inexperienced traders. They see another low and jump to the conclusion that the downtrend is continuing. But Wyckoff traders look for differences in character. Is the new low sharp or shallow? Is it supported by heavy or light volume? Does it follow through or fail quickly? When thrusts shorten, the answers to these questions begin pointing in one direction. Supply is weakening, not strengthening. Another important sign appears in the velocity of the declines. Early in the trend, the stock may drop 5 or 6% in a day or more with ease. But as the trend matures, the drops might be 2 or 3%, sometimes even less. And even if the price technically moves lower, the speed is different. It's sluggish. It lacks the violent push that characterizes true distribution. Traders often describe this as the decline, losing energy, and that's exactly what's happening. Selling is no longer enthusiastic. It's routine. It's exhausted. When downward thrusts shorten, it also suggests that buyers are no longer stepping aside. Earlier in a decline, buyers don't want to catch a falling knife. They stay away. They wait. But as price reaches levels where demand finds value, or where the composite operator begins absorbing, buyers slowly begin to push back. Not aggressively, but consistently. They start supporting price, absorbing supply, and preventing deeper breakdowns. That absorption shows up visually as shorter declines and more frequent stabilizations. Look at how the price behaves after each thrust. Does it bounce faster than before? Does it hold a level that previously would have broken? Does it form small intraday recoveries that weren't present earlier? These nuances matter. Shortening thrusts often produce quicker stabilizations because demand is increasingly ready to intervene. Even if the public doesn't notice it, the chart reveals that the struggle between supply and demand is shifting. You may also see the volatility of the thrusts change. A decline that once produced wild, emotional candles might start producing narrower, more controlled bars. This compression is part of the transition into a trading range. It signals that the market is settling into a zone where buyers and sellers are more balanced. And while balance doesn't automatically mean accumulation, the shortening of thrusts is one of the first ingredients needed for it. The market must stop falling before it can stabilize, and it must stabilize before it can form the cause for a future markup. Everything begins with diminishing downside force. One of the most overlooked aspects of shortening thrusts is how they psychologically affect traders. The public often becomes so anchored to the idea of a downtrend that they interpret every small decline as confirmation of weakness. But what they fail to notice is that the thrusts aren't doing what they used to. This misreading is exactly what the composite operator relies on. The best accumulation happens when the public still believes the stock is weak, even while the structure is already showing signs of strength. Shortening thrusts help maintain that illusion, and when you combine these shrinking moves with the broader context, declining volume on sell-offs, muted reactions to bad news, stabilizing support zones, you start to see a picture forming. A quieter, more controlled market. A market where selling lacks urgency. A market where deeper forces are shifting.